They crashed Japan on purpose. I want you to actually sit with that sentence for a second because I know exactly how it sounds. It sounds like a conspiracy theory, the kind of thing you'd scroll past on the internet at 2 in the morning. But I spent 30 years reading balance sheets, buying companies, selling companies, sitting across the table from bankers and fund managers, and watching how money actually moves when nobody's explaining it to the public. And when you line up what happened in Japan over the last few months with what happened in the US stock market at the exact same time, it stops looking like a coincidence real fast. Japan just got forced into raising interest rates after almost 40 years of keeping them near zero. That single move is now ripping through the entire global financial system, and it's landing directly on your 401 kilobits, your index fund, and every tech stock you've been told is the safe bet. I'm not telling you this to scare you into doing something stupid. I'm telling you because nobody in the mainstream financial media is going to sit down and connect these dots for you in plain English. So I'm going to do it myself. Right now, no jargon, no spin. Before I go any further, hit subscribe. I mean it. What I'm about to walk you through in the next 30 minutes is the exact kind of thing hedge funds pay. Research analysts 6 figures a year to explain quietly to their richest clients in private meetings that you and I never get invited to. You're getting the same information for free right here. I don't run ads on this channel. I don't have sponsors whispering in my ear about what I can and can't say. So the only thing I owe you is the truth as I see it. Subscribe now because this story isn't finished. It's just getting started, and I plan on tracking every twist as it happens. So let's start with the part almost nobody explains correctly, because you can't understand any of this without understanding this first piece. For close to 4 decades, Japan kept its interest rates parked at basically zero. Sometimes they went negative, meaning banks were technically being paid to borrow money. Think about what that actually means in practice. If you're a big investor, a pension fund, an insurance company, a hedge fund, anybody managing serious money, and you could borrow yen for next to nothing, what do you do with it? You don't just sit on it. You borrow that cheap yen, you convert it into dollars, and you go put that money to work somewhere. It actually earns a real return. U.S. stocks, U.S. real estate, U.S. tech companies, U.S. Treasury bonds. This strategy has a name on Wall Street. It's called the carry trade, and it has been quietly running in the background of the entire global economy for decades. We're not talking about a few $billion here and there. We're talking about trillions, built entirely on one simple bet that Japan would never, ever raise rates in a meaningful way. Here's the thing about a bet like that. It works beautifully right up until the day it doesn't. And this year, Japan did the exact thing that almost everybody on Wall Street swore they'd never do. Inflation in Japan got too hot to ignore. Their own currency was getting hammered on global markets, and the Bank of Japan started raising rates. Now, on paper, the moves don't look huge. A 1/4 point here and a 1/2 point there. But you have to remember, this is a system that was built entirely on the assumption of free money. In a system like that, even a small rate hike is an earthquake because it changes the math for every single fund, every institution, every trading desk that took that carry trade bet. All of a sudden, the yen they borrowed for free isn't free anymore. It's costing them real interest. Every single day the position stays open. So what do they have to do? They have to unwind the trade. That means selling off whatever they bought with that borrowed money in order to pay back the loan before the interest eats them alive. And when I say sell, I don't mean trim a little here and there. I mean sell across the board, stocks, bonds, whatever's sitting in the portfolio, because the loan doesn't care what your positions look like. It just wants to get paid. Now here's where this stops being some abstract future risk I'm warning you about, because it's already happening. Japan has been dumping U.S. Treasury bonds, meaning selling them off in big waves. Some of the largest sell-offs we've seen in years. And at almost the exact same moment, the U.S. quietly started stepping in to buy up a big chunk of that debt itself. Nobody announced this with a press conference that says, hey everybody, we're printing money to soak up the debt. Japan is dumping, so the bond market doesn't panic. That's not how this works. They give it some boring, technical, forgettable name, so 99% of people scroll right past the headline without a second thought. But strip away the label for a second and just look at the mechanics underneath it. Money is being created to absorb debt that a foreign country is actively dumping at the exact same moment that country's central bank is forcing a massive global trade to unwind. I've been in enough deal rooms to know that when this many moving parts line up in the same tight window, it's not luck. Somebody upstream saw this coming and built the fire hose before the fire even started. I've built and sold companies. I've seen how information actually flows before the public ever hears about it. Japan didn't stumble into a rate hike by accident after 40 years of avoiding one. The pressure built for years underneath the surface, and when it finally broke, the people closest to the situation had plenty of time to position themselves before the rest of us even knew there was a fire, which brings me to the part that should actually make you a little angry, because none of this is some abstract macroeconomics lecture for people with finance degrees. This is your money, sitting right there in accounts you probably don't check that often. If you have a 401 kilobits through work, if you own index funds, if you own basically any big US tech stock, you are exposed to this whether you realize it or not. Here's why it matters so much. A huge chunk of the demand that's been propping up US stocks for years, especially the giant tech names everybody loves, came from that same wave of cheap money flowing in from places like Japan. When that flow reverses, when big institutions are forced to sell us assets just to pay back yen loans that suddenly carry real interest, that selling pressure slams directly into the market. It doesn't matter if the company you're invested in has great earnings that quarter. It doesn't matter if the fundamentals look rock solid on paper. When a wave of forced selling hits because of a currency trade unwinding on the other side of the planet, your stock price takes the hit anyway. That's the uncomfortable truth about how tangled up this whole system is. Your retirement account can get hurt because of a decision made in a boardroom in Tokyo that most people couldn't even find on a map. And I want to be really clear here, because I know exactly how this sounds. I am not telling you to panic and dump everything you own tomorrow morning. Panic is how regular people lose real money, because they sell right at the bottom out of fear, and they buy back in right at the top out of greed every single time. What I am telling you is to understand the machine, because once you actually understand how it works, you stop being the last person in the room to find out what's happening to your own money. Let's talk about who actually benefits from all of this, because in every one of these situations, somebody always does. Warren Buffett. And look, I have a lot of respect for the guy who just sold off close to $285 billion worth of Japanese bonds right before new Japanese debt numbers came out publicly. Now, maybe that's a total coincidence. Maybe Warren just felt like rebalancing his portfolio that particular week for no reason at all. But I didn't build what I built by assuming the smartest money in the room moves without a reason. When somebody with that level of information and that level of access makes a massive move right before bad news hits the wire, you pay very close attention to the timing, not the press release that comes out 3 days later trying to explain it calmly. Then you got Goldman Sachs, and this next part is wild to me, because they basically admitted in their own internal research that eventually leaked out into public view that a huge chunk of the record profits big tech has been reporting are, let's say, generously accounted for. I'm being polite about it on purpose. When one of the biggest banks on Wall Street is quietly telling its own private clients that the profit numbers driving the stock market to all-time highs aren't nearly as clean as the headlines make them sound, and the general public has absolutely no idea that conversation is even happening. That tells you everything you need to know about who this system is actually built to protect. It's not built to protect you and your index fund. It was never built to protect you and your index fund. It's built to protect the people who get the real information first, days or weeks before you ever hear a whisper of it. Let me back up for a second and explain why the dollar side of this matters so much. because a lot of people hear the US is printing money and they just nod along without really understanding what that does. The US dollar is the reserve currency of the entire world. That means most global trade, most oil contracts, most international debt, all of it gets settled in dollars. Not yen, not euros, dollars. That status is basically a superpower. It lets the US borrow money cheaper than almost anyone else on the planet because everybody needs dollars anyway. But that superpower comes with a catch. Every time the US prints more dollars to paper over a problem, whether it's a bank bailout, a pandemic, or quietly soaking up debt that Japan is dumping, it chips away a little bit at the value of every dollar already sitting in your bank account. You don't feel it all at once. You feel it slowly at the grocery store, at the gas pump, in your rent. That's what inflation actually is at the root of it. It's not some mysterious force. It's the direct result of more dollars chasing the same amount of stuff. So when I tell you the US is quietly printing to cover for Japan's bond dumping, I'm not just describing some technical accounting maneuver happening in a spreadsheet. Somewhere, I'm describing something that eventually shows up in your weekly grocery bill, whether anybody explains the connection to you or not. Now add it all up in your head, because this is where it gets scary. Free money from Japan suddenly gets expensive overnight. The US quietly starts printing to cover the gap that leaves behind. Buffett sells nearly $300 billion in Japanese debt right before the bad numbers become public. Goldman Sachs admits the profit numbers propping up big tech stocks are inflated. And meanwhile, right now, today, US stocks are priced more expensively relative to actual earnings than they were right before the crash of 1929. Let that number sit with you for a second. Not before some random, forgettable correction from a few years back, before 1929, the single most famous stock market crash in American history, the one that helped kick off the Great Depression. And today's market is priced even more aggressively than that one was right before it fell apart. Now let's stack one more piece on top of all of this, because honestly, it's the part that worries me the most. And that's the AI build-out everybody's obsessed with right now. Every major tech company on the planet is currently pouring an absolutely insane amount of money into building data centers to power artificial intelligence. We're talking hundreds of billions of dollars in spending, all riding on the bet that AI is going to generate returns big, enough down the line to justify every dollar of it. Here's the problem. Nobody wants to bring up the earnings calls because it kills the vibe. These data centers need a staggering amount of electricity, an amount that the current US power grid physically cannot supply at the pace these companies are promising. I'm not saying it might struggle. I'm saying it cannot, full stop. There isn't enough power generation capacity being built fast enough anywhere in this country to match what these companies are telling investors they're going to deliver. So you've got trillions of dollars in market value sitting on top of a promise that runs headfirst into a physical wall, not a financial one, an actual, you cannot bend the laws of physics wall. When investors slowly start realizing that the return on all this AI spending isn't showing up as fast as promised because the actual infrastructure to power, it doesn't even exist yet and won't for years, that becomes another leg that can get kicked out from under this market. And it's happening at the exact same time as the carry trade unwinds and the inflated profit numbers I just walked you through. These aren't three separate stories. They're one story wearing three different masks. And look, I love AI. I've invested in AI companies myself. I think the technology is real and it's going to change how we work in ways we can't fully picture yet. This isn't me telling you AI is a scam. It's me telling you the timeline. Everybody's been sold is a fantasy. You cannot build enough natural gas plants, nuclear reactors, and transmission lines in 2 or 3 years to power what these companies are promising in their investors. DEX, energy infrastructure, takes a decade to build under normal circumstances, sometimes longer once you factor in permitting and construction. Meanwhile, the spending on the data centers themselves isn't slowing down one bit. It's accelerating quarter after quarter. because nobody wants to be the company that blinks first and tells Wall Street they're pulling back. So you end up with an arms race where everybody keeps spending billions they don't fully have a return on yet, propped up by stock prices that assume the return is coming any day now. That's not a business plan, that's a bet. And bets like that eventually get called, let's talk about the history piece a little more directly, because I don't want you to just take my word for the pattern. I want you to actually see it. In the dot-com era, the story everybody told themselves was that the internet changes everything. So normal valuation rules don't apply anymore. Just buy the story and hold on. Companies that had never made $1 profit were worth more than entire industries. And then in the spring of 2000, the money simply stopped flowing in fast enough to keep the story alive, and it all came apart in about 18 months. In 2008, the story was that housing prices always go up, banks are sophisticated enough to manage the risk, and the regulators have it handled. Turns out none of that was true either, and it took the entire global financial system down with it. Right now, the story is that AI changes everything. Tech earnings are unstoppable, and a decades-old currency trade quietly unwinding on the other side of the planet has nothing to do with your portfolio. I've read this movie enough times to know how it usually ends for the people who believe the story a little too hard. I want to talk about history for a minute because this is where I think a lot of smart people still get it wrong. They hear the phrase, "this time is different," and they relax their shoulders and go back to scrolling their phone. I have heard that exact phrase before. Every single crash I have lived through in my career. I heard it before the dot-com crash, when companies with zero revenue were worth billions of dollars simply because they slapped .com on the end of their name. I heard it before 2008, when everybody swore up and down that housing prices never fell nationally all at once, right up until the month they did. Every single time, right before the fall, there's a loud, confident chorus of people telling you it's different this time. The fundamentals are strong. Don't worry about a thing. Just stay invested and stay calm. And every single time, a small number of people who actually understood what was really happening underneath the surface quietly moved their own money out of harm's way first, while everybody else got told on television to stay the course. History doesn't repeat itself exactly the same way twice. But I promise you it rhymes close enough that you should be paying very close attention right now instead of scrolling past this video and forgetting about it in an hour. So here's what I actually want you to walk away and do with all of this. First, go find out exactly what you own. If your 401 kilobits is sitting inside a target date fund or an index fund that's heavily loaded up with the same handful of massive tech companies everybody else on the planet owns, you need to know that fact about your own money. There is nothing inherently wrong with owning those companies. I own plenty of them myself, but you should know exactly how concentrated your risk really is. Instead of assuming the word diversified automatically means safe, because a lot of funds that call themselves diversified are secretly just the same 7 stocks wearing a different label. Second, pay close attention to what happens next with interest rates both in Japan and here at home, because this carry trade unwind is not a one-week news story that disappears by Friday. It is going to play out over months, maybe longer, and it is going to create real uncomfortable volatility the entire way through. Third, and this is the big one, stop accepting the calm version of the story just because it's easier to hear and doesn't ruin your evening. The people out there telling you it's a record market and everything is completely fine are not necessarily lying to you out of malice. Most of them just don't want to be the one person on live television who says the uncomfortable thing out loud. One more thing before I wrap this up, because I think it matters more than people realize. None of this means the stock market is guaranteed to crash next Tuesday. And anybody who tells you they know the exact date is selling you something. Markets can stay disconnected from reality longer than most people expect, sometimes for years, because momentum and psychology carry things further than the underlying numbers ever should. What I'm handing you here isn't a prediction of the exact day it breaks. It's a map of the pressure building up underneath the surface so that when the cracks do start showing, and history says they eventually do, You're not caught flat-footed wondering what happened. You'll already know. I built my entire career by looking at what's actually happening inside a business instead of just reading the press release that gets handed out about it. That is the exact same instinct I need you to apply here, starting today. Look at the real numbers. Look at the real timing. Look at the actual moves the smartest, best-informed money in the world is quietly making. Not just the calm headline that gets slapped on top of it for everybody else to read. If you found this useful, and I have a feeling you did, if you made it all the way here with me, hit subscribe right now, because I am going to keep tracking this story as it continues to unfold. And I promise you, there's a lot more coming down the pipe. Drop a comment and tell me straight up what you think is really going on underneath all of this, because I actually read every single one, and I want to know if you're seeing the same pattern I am. This was never about scaring you. It was about making sure you're not the very last person in the room to find out what already happened to your own money. Stay sharp, keep your eyes open, and I will see you in the next one.